Hi there, thanks for tuning in. Today, we're going to be doing an analysis and valuation of Crocs Inc. Of course, we know them, some people love them, these are Crocs, right? And when I was looking at their website as research for this video, I was kind of surprised to see just how many different products they have. Like, they even have work shoes, which is pretty crazy, slip-resistant shoes, shoes for nurses, standing shoes, chef shoes, hospitality shoes, gardening shoes. That's a lot. And it shows me that they're kind of a wider brand than just what we look at as the clogs that people wear when they're relaxing at home, right? I see some of my friends that swear by Crocs and they wear it anywhere they go, no matter if we're hiking, if we're just lounging around, walking around. So it's very interesting seeing just how diverse this brand has become. And maybe it reflects in the financials. So let's start just taking a look already at their latest investor presentation, which is Q3 2023. Now, they have quite diversified sources here. They have Crocs and the Hey Dude brand, which was an acquisition that they made around 2022, if I'm correct. Geography-wise, most of their sales are in North America, but Asia Pacific is the greatest growing area, and then Europe, the Middle East, Africa, and Latin America is another potential growth area. They also have some digital penetration, but clearly they can make more. Right now, they're selling at retail shops, but theoretically, that is an area that could grow a lot. And then the channel is mostly wholesale, direct to consumer. It's almost 50-50, but ideally for them, it would be more direct to consumer in the future. Why? Because your margins are higher if you do direct to consumer. Now, their inventory has been decreasing, which is actually something you want to see. If you have a lot of inventory, you have to get rid of it maybe at a discount, because that just means like people are not buying it, right? If you have a little too much, you have to get rid of it quickly. It's not great to see. So over time, between Q3 2022, year-end 2022, and now Q3 2023, you've seen a great decrease of inventory. And that's wonderful to see. That means that a problem that many retail companies had towards the supply chain issues caused by the pandemic and whatnot, those are going away for Crocs, hopefully, right? Now, they also talk a little bit about their debt mix. A lot of companies, to acquire other companies, use debt, or they acquire the debt of those new companies. Hey Dude seems to have had debt, and Crocs took a little bit on of that debt. So they had originally 2.25 times of EBITDA in debt, essentially. Now it's closer to 1.7 times, and their goal is to have between 1 and 1.5 times of debt. So that's pretty great. It means two things. One, it means that if you're a shareholder, the value of the stock will probably go up for you, because when you own a business, you also own the debt of that business. If you own less debt, then it's more valuable, very clearly. And the other very important thing is that in the case that they were to, say, file for bankruptcy, right, and a judge were to say, okay, you have to repay all your creditors, usually the shareholders are last. First, they're going to pay the banks, they're going to pay bondholders, they're going to pay some senior credit holders, venture debt, and then if anything is left over, the stockholders get paid. The less the net leverage ratio, the more the stockholders will get paid. But they're committed to very quickly deleveraging. It's wonderful that they repaid $940 million since the acquisition, and they are clearly repurchasing shares and paying down debt. Again, that is a business owner. As you owning the business, it increases the value of your ownership. So that's just something that we like to see. Now, we also look at the guidance for the full year 2023, and they adjusted their guidance slightly down. That's okay. That's to be expected. I think every single company has pretty much done that. But yeah, this is just something that we'll have to see. But you can see that everything is going down slightly, but not significantly so. So that's probably a sign still of confidence that despite a very, I would say, terse or a very stubborn economic environment, they're holding tight. Okay? Now, I want to talk about the financials. I'm using here the ROIC.ai and markets.sh website to look at 10 years of financial data. And as you'll see, the revenue growth is monstrous. It's crazy. It's something that The fact that from 2021 to 2022, they managed to grow revenue 53%, that is insane. And you know what? Most of these years, if you look at gross profit grow more than the revenue, that means that the gross margins are improving too. Most of these years, you can see like 2020, 21, 2018, 2017, you can see that the gross profit actually grew more than revenue. The gross margins grew. Producing one unit of one shoe or one extra unit of product was cheaper. And every year that gross profit grows more than revenue. So that is wonderful. That is something that we care a lot about, and that matters to them as they scale up. Well, you want to see a company that as it scales up, producing units, sure, it'll cost more because you're producing more, but at the same time, each unit should cost less. Now, you can also see that over the course since 2011, basically, they should not necessarily turn in a positive net income, and free cash flow was basically zero for many years here. From 2013 to 2016, you pretty much had nothing in terms of cash flow, which as a value investor is what I want. I want free cash flow. Now you see this company that from 2018 onwards turns up with revenue and with net income and with free cash flow mostly on a growing basis. So this is very important to see. This is a healthy thing to see. And likewise, something that sometimes can be a red flag is if free cash flow is consistently above revenue. There has to be a good reason why. Oftentimes it's a little of financial magic being done there, or accounting magic being down there, or there's a lot of stock-based compensation. Free cash flow is a little lower than net income every time, which I think overall is a green flag. Now, we also see the margins here, as I was talking about. There's the gross margin, the operating margin, the profit margin. And as we saw, from 2013 to practically 2016, they weren't a profitable company. This has completely been turned around, okay? And if you look at 2020 and 21, the profit margin was greater than the operating margin. This is probably because in the pandemic, they got some tax benefits and whatnot that made them regain some of that money. But now they're back to a more normal structure that you would see in a normal company, which is gross margin is higher than operating margin, which is higher than profit margin. But now you see these numbers consistently way higher than even in some good years like 2011 and 2012. They've just grown and grown and grown. So this is what we like to see. And we like to see that all the margins are pretty much either steady or above previous levels. So honestly, good on Crocs. Very good on Crocs that they can manage their operating margins at around that 27% level, that they can manage to have net income margins or profit margins that are also between that 20% and even sometimes pushing towards 30% level, and that their gross margins are really steady. So I'm going to be doing a discounted free cash flow model to get an actual fair value for Crocs. These units are all in millions, by the way, and I want to sort of see, based on their historical free cash flow growths, what they can potentially be worth. What I'm doing here is I am grabbing the expected growth from the guidance that they gave. I am also lowering that growth a little bit for 2024, just assuming the worst, right? That they sort of stagnate, maybe lose a little bit of revenue. So I'm saying maybe revenue goes down by 1%, and then I'm going to grow revenue 2025, 2026 by 5%, because that is still way below what they usually historically grow. They grow usually at around 10%. I'm growing it by 5%, and then I'm saying perpetual growth is 3%, which may be underrating this company, but I'm just doing this as a very conservative estimate, okay? Now, I am going to divide that by the total number of shares out, and I get a fair value of $127.48. Now, I need to adjust for debt. So I grab the total net debt that they have right now, I subtract that, and the fair value that I get post-debt is of $91.84. So that's the value that I think each share of Crocs is worth. If you account for the net debt, Crocs right now is at $106.81 US as of midday on February 13th. Now, what you'll see here, in the last 5 years, Crocs has been up and down and all over the place, okay? I bought it around here. I bought it around this 50 level. I thought it was a great deal. I sold it around here because I thought it was a little too much. I thought at the beginning of 2023, it maybe wasn't worth around $125 where I sold it at. And now I'm looking at it again and I'm seeing that the profile has maybe changed a little bit. So at this 106 level, the PE ratio is around 10, which is pretty good. And there is a lot of potential for growth still. Crocs is still growing. Crocs is still showing that it can perform and that it can keep those margins. So even though this value is a little off, it's not significantly off. It's not a stock that I would say it's so overvalued I would never consider it. As a matter of fact, I think this is value. But is it at the right price? Well, Crocs has stellar revenue, they have a stellar margin, they have stellar net income and free cash flow growth. The net debt position may be shaving off some dollars off of my valuation, but the emphasis on paying it down brings confidence to the company. So this is something that in this model we get two numbers, this 127 and this 91. What the true value is probably neither of these. Is probably going to be either somewhere in between or more if the growth rate is more in the long term. So what you have to account for here is how much do you actually care about the fact that this company has debt? And this is where you may want to look at the debt mix. This debt is something that they got from acquiring Hey Dude, and they're paying it down really quickly. So if that doesn't bother you at all, then maybe the value for you is closer to this first number. If not, maybe it's closer to that second number, depending on how conservative you want to be. Now, pair this with share buybacks, and your ownership becomes more valuable over time. Of course, they seem to be doing a good job at just returning value to shareholders through that paying down of debt and the share buybacks. Below $100, I honestly see Crocs as a potential buy and as a very strong buy below that $80, $90 level. Watch the moat though. So Crocs competes with every single shoe retailer basically, despite having no direct competitors itself. There's nothing that I think is necessarily analogous to Crocs, but I can also just choose to wear flip-flops. I can choose to wear any kind of sandal. I can choose to wear any other kind of shoe. So you can say that Crocs has a moat in the sense that nothing is quite exactly like Crocs, but at the same time, they are not this infallible company. They're not this company that you need. At the end, it's consumer discretionary, and that should also count to your risk calculation. Consumer discretionary companies suffer a little more during recessions. They also suffer a little more in retail. That's why they're trying to be more direct to consumer. So that's just something to take note of to see if it fits in your portfolio. So here I'm asking myself, what drives value, right? In Crocs, what drives value is the monstrous growth rates, which have been amazing. It's the share buybacks and the debt paydown. Is this enough for you? Does this drive so much value that you have to own it in your portfolio? That's a great question to ask with both this company and any other business that you want to own, that you want to be a part of as a business owner. With that said, thank you so much for watching this video. I had a lot of fun analyzing Crocs. If you want me to analyze any other stock, feel free to comment down below and I'll be happy to take a look at it. Thank you so much. Remember to like and subscribe. It really helps me out, and have a great rest of your day.